Welcome to vTalkInsight, Market Drivers Daily for April 2nd, 2026. Geopolitical risk around the Strait of Hormuz is colliding with an oil shock, forcing a rapid reset in equities, credit, and currencies. Today matters because markets are shifting from hoping for a quick fix to pricing in a longer, messier adjustment. Geopolitics and energy are now the single dominant macro force, with the Strait of Hormuz at the center of the story. Brent is holding well above $100 a barrel, and repeated price spikes are feeding straight into risk-off swings across global equities. Compared with earlier in the week, markets appear less convinced this is a brief scare and more focused on the possibility of a medium-term supply shock, which keeps volatility elevated and narrows the room for policy mistakes. The effective closure of the Strait of Hormuz has choked off around a fifth of global oil flows, with Iran only allowing selective transits while most Gulf exports remain constrained. Spot benchmarks have reacted sharply. Brent has surged into the $108 to $113 range, and several desks now see a path toward $133 within weeks if current disruptions persist. Some scenario work even flags $200 oil should the conflict and shipping disruption extend beyond June, especially if infrastructure damage in producers like Kuwait and Iraq proves significant. Futures curves remain in steep backwardation, signaling hopes for normalization later in the year, but the depth of the physical tightness suggests that optimism could be challenged if Hormuz stays impaired. The macro channel is increasingly about stagflation risk rather than just headline energy volatility. In the United States, sustained high oil and gasoline prices are already weighing on consumption, with one estimate suggesting roughly $120 billion could be shaved off disposable income. Growth expectations have been marked down, with a first-quarter gross domestic product forecast closer to 1.9% and a wider cone of downside scenarios if the shock persists. Yet demand destruction for oil itself is seen as unlikely until prices move into the $150 to $160 range, implying that prices could run higher for longer before consumers and corporates meaningfully change behavior. Energy importing economies in Europe and Asia look more exposed, facing terms of trade shocks, weaker currencies, and limited fiscal space, all of which raise the risk of slower growth alongside higher inflation. This backdrop is feeding directly into rates, currencies, and equity sector performance. European inflation expectations have risen as energy shocks bite, and markets are toying with the idea that the European Central Bank may need at least one more hike to defend credibility, even if that risks amplifying growth headwinds. Long-dated government bond yields in developed markets, particularly in the United States, are under upward pressure from larger fiscal needs and the cost of building resilience, while short-end cuts are being repriced out as energy keeps inflation sticky. The dollar is strengthening on flight to safety and growth concerns, weighing on more fragile currencies, such as sterling and several energy importing emerging markets, while traditional havens like the Swiss franc have not yet delivered the usual protection. Equities are displaying a classic rotation. Major indices, such as the S&P 500 Nasdaq, are down around 1.5% to 2%. European benchmarks are off more than 1%. Airlines and travel names are under material pressure, and oil majors are rallying on windfall price support. There is, however, a counter-narrative built around United States resilience and structural growth drivers. The United States is now a net energy exporter. Energy carries a relatively small weight in its consumer price basket, and ongoing fiscal spending plus artificial intelligence-driven capital expenditure are supporting corporate earnings, with S&P 500 profit estimates still edging higher despite the oil shock. United States equities have fallen less than global peers, with a drawdown of roughly 5% versus steeper declines in Europe and Asia, and recent record merger activity and strong investment-grade issuance underscore that underlying corporate confidence remains intact. Diplomatic headlines, such as talks between Iran and Oman on a protocol for Hormuz traffic, have at times eased risk aversion and pulled equities off the lows, although crude prices have stayed well above $100. indicating a persistent risk premium. Key watch points now are whether military operations in Iran escalate or stabilize, how long Hormuz remains partially closed, and how central banks, especially the European Central Bank and the Federal Reserve, balance upside inflation risks against slowing growth as we turn to the knock-on effects in global supply chains. The energy shock is now morphing into a broader supply chain story, where prices are only part of the problem. Physical shortages, transport rerouting, and policy-driven trade frictions are combining to create pockets of scarcity that can hit growth even if headline crude prices eventually stabilize. This second-round effect is where the macro damage can deepen because it constrains volumes, not just margins. The most acute stress is in refined fuels. Diesel and jet fuel prices in Europe have spiked to around $200 per barrel equivalent, and inventories in Asia are already tight, with demand destruction emerging in some markets as costs bite. Industry commentary suggests Europe could face outright jet fuel shortages by May if disruption around Hormuz persists, raising the risk of grounded aircraft and capacity cuts. Airlines are contending not only with higher fuel costs, but also with closed or restricted airspace and widespread flight cancellations linked to Middle East conflict, forcing some regional carriers to fly empty planes simply to reposition fleets. Travel bookings from Europe to the United States have dropped sharply, with a move from roughly 10 to 11% declines to more than 30% year-on-year. And while some travelers are shifting to rail, capacity is nowhere near sufficient to offset the hit to aviation. Beyond energy, multiple supply chains are fraying at once. In Italy, construction materials such as bitumen have seen price jumps of up to 50% since the Gulf conflict began, and some suppliers are simply failing to deliver, leaving legacy contracts without automatic price adjustment badly misaligned with reality. Helium supply for semiconductors is another watch point. Disruptions have not yet materially hit the United States artificial intelligence sector, but firms are monitoring inventory drawdowns closely because any sustained shortfall could slow data center build-out. Even basic logistics are under strain, with major United States airports still vulnerable to sudden security bottlenecks due to staffing shortfalls, meaning wait times can spike unpredictably and add friction to business travel and cargo flows. At the margin, geopolitical uncertainty is even affecting global sports, scheduling, and sponsorships, adding another layer of planning risk for travel and events-related industries. Trade policy is amplifying these disruptions. The United States administration is moving toward higher tariffs on steel, aluminum, and copper derivatives, and is considering duties of up to 100% on certain patented drugs, which would ripple through pharmaceutical and manufacturing supply chains. Uncertainty over which products will be targeted and at what effective rates is complicating pricing and sourcing decisions for importers. Global goods trade grew an estimated 3 to 4% last year, but could slow to around 1.5 to 2% as Middle East conflict and higher trade barriers bite. Tariffs are already at levels comparable with the early 1940s, and roughly half of the associated cost increases have been passed on to consumers, leaving more to feed through into durable goods prices and potentially into food via higher fertilizer and logistics costs. The overall picture is one of rising bottleneck risk, but with important pockets of resilience. China has instructed private refiners to keep fuel production at last year's levels even at a loss, aiming to stabilize domestic supply, while transatlantic air travel demand remains surprisingly robust in the near term as passengers bring forward trips ahead of further potential price rises. The United States artificial intelligence ecosystem has so far weathered helium and component disruptions, and global goods trade is still expanding, albeit more slowly. Nonetheless, the combination of high energy costs, tighter trade policy, and fragile logistics raises the odds that supply chains become a key transmission channel from the current shock into corporate earnings and employment. For macro and credit risk, a critical question now is how much of this supply chain stress ultimately migrates into funding conditions and default risk, which leads directly into the evolving story in private credit. Private credit is moving from a decade-long expansion phase into a genuine stress test, shaped by both liquidity pressures and sector-specific risks. Redemption requests have surged, semi-liquid structures are bumping up against their withdrawal limits, and investors are questioning how robust these vehicles are in a world of higher rates, disruptive technology, and repeated macro shocks. The key issue is whether this remains a contained correction within alternatives or evolves into a broader credit tightening. Blue Owl sits at the center of the current debate. Its private credit funds have seen exceptionally high first-quarter redemption requests, with one technology income vehicle facing withdrawal demands of around 41% and another credit income fund near 22%, far exceeding the typical 5% liquidity window. The manager has enforced standard 5% redemption caps, turning the rest into a queue, while selling assets and relying on ongoing gross inflows to keep net outflows modest for now. Even so, Blue Owl's share price has dropped sharply, losing more than 60% from recent highs, and similar redemption caps at other alternative managers, such as KK, are reinforcing the perception of an industry-wide liquidity squeeze. Publicly traded business development companies are trading at steep discounts, and negative headlines are making it difficult for investors to gain conviction on when the selling pressure in these stocks might exhaust itself. Beneath the liquidity story lies a more concentrated credit risk problem. Stress is most visible in large, highly leveraged software loans originated before 2022, often with non-cash pay, recurring revenue structures that assume persistent low rates and high growth. Artificial intelligence-driven disruption has introduced a binary element to many of these business models, raising the possibility of very sharp value impairment if incumbents lose share quickly. There have already been steep markdowns in some software loan portfolios, lifting loan-to-value ratios and raising questions about whether current marks fully capture the downside. If banks and other leverage providers respond by tightening terms or cutting funding lines to business development companies and direct lending vehicles, funds could be forced into faster deleveraging or asset sales, increasing the risk of more disorderly price action, especially in tech-heavy vehicles. Set against that, several features argue for a more contained adjustment. Over the past 15 years, private credit vehicles have generally delivered higher compounded returns than public high-yield and loan indices, which has entrenched them as a core income allocation for many institutions. Secular demand for yield is rising as populations age, and institutional allocations remain steady even as retail inflows have slowed, helping to anchor funding for the stronger platforms. Managers with diversified credit franchises are already slowing new private deployment when liquid or distressed markets signal dislocation, keeping dry powder for better entry points and helping to avoid forced risk-taking. Current commentary emphasizes that most redemption pressure reflects liquidity preferences rather than a broad deterioration in underlying borrower fundamentals, that asset sales so far have cleared near par, and that stress is concentrated in a relatively small segment of large loans, while the lower middle market remains comparatively resilient. Looking ahead, the private credit landscape is likely to be defined by wider dispersion rather than systemic crisis. Spreads on new deals are already a little wider, indicating a more balanced environment where lenders can demand better terms, but also where weaker borrowers and less disciplined managers may struggle. Persistent negative headlines and equity drawdowns for listed managers could slow asset growth and push the asset class toward a plateau, similar to what has happened in parts of private real estate, even as long-term demand for yield endures. A crucial macro dimension is that reduced appetite for semi-liquid private credit could limit capital availability for small businesses that rely on lower middle market lending, incrementally tightening financial conditions on top of the current energy and supply chain shocks. Key indicators to monitor now include quarterly redemption queues, any sign of leverage providers pulling back, pricing on secondary sales of software-heavy loans, and whether stress in private credit begins to spill into broader credit markets or remains an idiosyncratic but manageable adjustment. To wrap up, The closure of the Strait of Hormuz has shifted the oil shock from a short-term scare toward a medium-term risk, lifting stagflation concerns and driving sharp rotations across equities, rates, and currencies. Those same forces are now feeding into real-world supply chains, from jet fuel and construction materials to tariffs and trade flows, raising the chance that bottlenecks, not just prices, weigh on growth. In parallel, private credit is undergoing a liquidity and confidence reset, centered on tech-heavy, semi-liquid vehicles, but with structural demand and institutional capital still supporting the broader asset class. How these three stories evolve and interact will be critical for cross-asset pricing into the summer. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.